Hims and Hers had a rough 2025 and early 2026. A partnership with one of the world's biggest weight loss drug makers fell apart. The stock crashed more than 30% in a single day. Then came a lawsuit, and a well-funded competitor is now ahead of them in the single most important health category of the decade. That chapter needs an explanation. And more importantly, it raises the question of whether the underlying business is still worth owning. Outside of that mistake, there are parts of this company worth looking at closely. A blood testing business that didn't exist a year ago, a roughly $400 million capital raise and a billion-dollar acquisition, and a bet on AI that could fundamentally change what the platform does. By the end of this video, you'll have a clearer picture of where the competitive advantage case is credible, where it isn't, and what you'd need to believe for the thesis to hold. When someone comes to the Hims platform, they fill out a detailed health intake, symptoms, history, treatment goals. That data flows into treatment plans. It shapes what gets prescribed. It informs follow-up care. And it stays on the platform, building up a picture of that person over time. Now multiply that across 2.5 million subscribers. The argument Hims management makes is that this creates a data loop that gets harder to replicate over time. More users generate more data. More data allows for better personalized treatment. Better outcomes attract more users. That loop, if it holds, creates something a new entrant with no patients and no data cannot easily match. Here's what that looks like in practice. Say someone signs up for hair loss treatment. 2 years later, their blood results flag a testosterone issue. The platform already knows their prescriptions, their history, their goals. A competitor starting from scratch can't offer that. Whether this loop is actually driving meaningfully better clinical outcomes is difficult to measure from the outside right now. What we can observe is the infrastructure being built around it. In November 2025, Hims launched Labs, a blood testing service starting at $199 a year with up to 130 health signals across its plans. Every blood result is another layer of data about each user's health sitting inside the platform. In May 2026, they went further. Hims launched Labs AI, an AI care agent that takes your blood results and translates them into personalized health insights, not generic health content, your numbers interpreted in the context of your own history, connected to your existing prescriptions, from a platform that prescribes treatments toward a platform that knows where your health is heading. That's the direction the business is moving.
Weight loss is the single most important category in consumer health right now, and this is where Hims stumbled. Some context on the drugs involved. GLP-1s, the class of weight loss medications that includes Ozempic and Wegovy, became the most talked about drugs in the world over the past few years. Demand far outpaced supply. When the FDA formally declared a shortage, it opened a window for compounding pharmacies, licensed facilities that can mix their own versions of a drug to produce lower-cost alternatives. Hims moved aggressively into that space. Millions of patients couldn't access or afford the branded drug. Hims offered an alternative at a fraction of the price. It made commercial sense at the time. But in February 2025, the FDA resolved the shortage. The legal window for compounding semaglutide closed. What Hims did next is where the problem started. What happened played out in two distinct episodes. The first was in 2025. In April of that year, Hims signed a brand partnership with Novo Nordisk, the maker of Wegovy, to distribute the authentic drug on the platform. It lasted 8 weeks. Novo terminated it because Hims had continued selling compounded versions while the partnership was active. The stock fell more than 30% in a single day. The second episode came in early 2026. Novo launched a new oral Wegovy pill in January at $149 a month through Ro, Weight Watchers, and LifeMD. Hims was not included. 1 month later, Hims launched a compounded copycat of that pill at $49. The FDA publicly warned against copycat drugs. Hims pulled the product. Then Novo sued. The stock fell roughly 18%. In the first case, Hims pushed until they couldn't. In the second, they pulled back quickly, but only after the FDA intervened. Meanwhile, Ro had taken a different approach from the start. They partnered with both Novo and Eli Lilly for their branded GLP-1 products and built their weight loss offering around legitimate partnerships. While Hims was dealing with lawsuits and regulatory pressure, Ro was building its brand in weight loss. Why does this matter? Because obesity affects roughly 37% of American adults, close to 100 million people. It drives cardiovascular disease, diabetes, and shortened lifespan. If you are building a long-term health platform, weight management sits at the center of that story. You cannot give up the weight loss category to a competitor and credibly claim to be that platform. Hims was right about the strategic importance of GLP-1. The execution didn't match the ambition.
In March 2026, Novo Nordisk and Hims reached a new agreement. Hims now offers authentic Wegovy injectables, the Wegovy pill, and Ozempic on its platform at Novo's self-pay prices. The lawsuit was dropped. This resolves the legal dispute. What it doesn't automatically resolve is the trust and perception problem in the weight loss category, which Ro built by doing this cleanly from the start. So how does Hims compete from here? The answer is in where they're putting the capital. In May 2026, Hims raised roughly $400 million through convertible senior notes, essentially borrowing at 0% interest, with lenders getting the right to convert that debt into shares instead of collecting interest. The proceeds go toward two things: a major international acquisition and AI infrastructure. In February 2026, Hims announced a $1.15 billion agreement to acquire Eucalyptus, one of Australia's largest digital health companies, with operations in the UK, Germany, Japan, and Canada. On pace to do more than $450 million a year in revenue, growing at triple digits year over year. This ties back to the data story we covered earlier: more patients, more data, a more capable platform. The acquisition is not just about new geographies. It's about adding scale to the thing that makes the platform defensible. The AI infrastructure spend is the other half. Hims is investing in the technology, the clinical data systems, and the architecture to run a personalized health platform at scale, one where AI interprets your data, connects your history, and guides your care over years. Labs launched in November 2025. Labs AI launched 6 months later. The Eucalyptus deal was announced in February. Financing was complete by May. That pace is unusual for a healthcare business. And here's where the weight loss recovery argument gets interesting. If two patients are both on Wegovy, but one platform also has their blood work, their metabolic history, and an AI tracking their progress, that platform can offer something Ro can't yet.
That's the differentiated position Hims is building toward. Whether subscribers come back in large enough numbers to get there is the open question. The concern from some investors is straightforward. The share price is depressed, and debt that converts into shares means existing investors end up owning a smaller slice. That's fair. But the capital is going toward growth, not propping up the balance sheet. To understand why management thinks these bets will pay off, look at how much the business has already changed. When Hims started, they had a narrow focus: hair loss and ED treatments for men, a small corner of health. Today, hair, skin, sexual health, mental health, menopause, weight loss, lab testing, and now international markets through Eucalyptus. These categories share data. The more of them on the platform, the richer the health record that builds up over time, and the harder it becomes for a single category competitor to serve that user as completely. This is the underlying argument for why Hims calls itself a consumer health platform rather than a telehealth company. Not just positioning, but a different theory of how the business grows. Think of it as a second growth cycle, the kind that starts slow, accelerates, and eventually levels off.
The first cycle was built on accessible telehealth and lower-cost drugs, convenient, affordable care for categories that were underserved. That cycle is maturing. The next one is being built on data and AI, a platform that accumulates your health history, learns from it, and serves more of your health needs over more years. Labs AI, eucalyptus data, scale, and future plans around wearable data, these are all investments in that second cycle. Whether it materializes is the central question for anyone evaluating this stock. The financial data so far is broadly consistent with this direction. Full year 2025 revenue was $2.35 billion, up 59% year over year.
Subscriber count reached 2.51 million, up 13%. Revenue growing faster than subscribers means each user is spending more, which is what you'd expect if the multi-category expansion is working. So that's the full picture. The question is what it adds up to. On the data and AI side, the structural logic is credible and the infrastructure is being built, but whether it actually keeps subscribers on the platform long enough to matter is still unproven. That's the honest position right now. On capital allocation, the bets are large. Eucalyptus acquisition, AI platform build-out, roughly $400 million in 0% convertible financing. No prior track record at this scale. On platform expansion, revenue per subscriber peaked at $84 in Q1 2025 and dipped to $80 in Q1 2026. Management's plan is to grow it back through branded weight loss products, labs, and new categories like testosterone and menopause. That's the number to watch. On GLP-1 execution, the new Novo deal is in place, but rebuilding consumer trust takes time and sustained execution, not just a resolved dispute.
The overall picture, a company with a credible platform argument and real execution capability that made a significant mistake in its most important growth category at a critical time. The argument for owning this stock is not broken, but it's under more pressure than the top-line revenue numbers suggest. What you'd want to see: revenue per subscriber climbing back as labs and new categories scale, and Wegovy subscribers staying month after month, not just signing up. These won't tell the whole story, but they'll tell a lot of it. This video is for informational purposes only and is not financial advice. All investments carry risk. Please make decisions based on your own research and circumstances.